Well, let's get across the market open now with Kyle Rodder from capital.com. Happy Monday, Kyle. So we got some stronger than expected jobs data out of the US on Friday. What exactly did the data show?
Well, I mean, just in terms of the numbers, a drop in the unemployment rates of 4.1%, a far more significant increase in employment of, well in excess of 200,000. Wages were fairly moderate, which was probably, the only silver lining. But effectively what the data showed us was that, not only is US economic activity fairly solid, that's translating still into fairly solid jobs growth. There were sort of hopes that perhaps we'd see a fairly moderate, perhaps Goldilocks number in this set of NFPs, which, it was anything but. So, really it shows, or at least the reaction of the markets with equities coming off and, obviously yields, rising off the back of the data too, is that we've sort of shifted from this focus on, growth and, good news being good news to one where, we're much more concerned about inflation and inflationary risk and good news being bad news. So this continued push up or sell off, I should say, in global bonds and, the subsequent push up in global bond yields is having this effect of, leading to a revaluation of equities, the stronger US dollar. And now everyone's kind of expecting more or less that the Fed won't be in the position to lower interest rates until the back end of this year. And, already there are some commentators suggesting that maybe the cutting cycle is finished.
And the 10-year could potentially break above 5%. What would that mean?
Well, it could potentially continue this really significant re-rating in equities. And, the last time that we did see the 10-year around that kind of 5% mark was, October 2023. It did mark a pretty significant, low in the market. Not the low of the big, rate hiking sell-off, but still one that was fairly meaningful and sort of showed, the difficulty that equities had in maintaining, an uptrend and fairly lofty valuations with a 10-year at about 5%. So, I mean, if you look at kind of the numbers at the moment, the data's strong. We also got some inflation expectations figures out of the University of Michigan that suggested that long-term inflation expectations are at the highest, around 3.3% since 2008. There are all these signals that the US economy is running reasonably hot, going into a CPI number, it has to be said. And then, you add to the fact that, this is a strong economy before, running into potentially pro-cyclical fiscal policy from the Trump administration, deficits perhaps, 6-7%, which is consistent with, effectively major downturns and periods where policymakers are trying to reflate the economy, not periods where the economy is clearly running, very close to its full potential. All of that suggests that, bonds could continue to push towards 5%, go even higher than that. And that given the fact that we have seen equity valuations so lofty going into the end of last year, that this drawdown in equities could continue both in the United States and around the globe. So it's a very, very significant question. And of course, as to just the market volatility that begins in the bond market because of the policy uncertainty, but obviously spreads across financial markets more broadly.
And the Fed is set to meet in 2 weeks. So what are markets pricing in now for that meeting?
Well, effectively, we've got a cut there being taken off the table. It was already sort of taken off the table, if you will, in December. But, slowly but surely we're seeing, the odds of any rate cut being sort of sliced into the single digits. So all but, unlikely, or very, very unlikely, and all but certain that there will be no cut at that next meeting. The question is the timing of that next cut and how many cuts we get in 2025 and how the market's positioned for that. Because, I mean, what we did see after the December Fed decision, and I suppose was somewhat reaffirmed in the minutes last week, was that there is this upside risks to inflation that the Fed thinks that maybe only 2 cuts this year are appropriate, and off the back of that and that kind of uncertainty that we saw because of probably that dissent in the commentary, the upward revision to some of the Fed's forecasts. This possibility that there is this sort of divergence of views on the Fed, more generally speaking, the market's already pricing in the low risk that the Fed wouldn't cut the 2 times that it projected or said it sort of expected to, if you will, in the summary of economic projections, and we're sort of pricing in the high risk that there might only be 1 cut this year. This data has only sort of reaffirmed that even further. So now we've got the markets pushing back the timing of that first cut to about October. That's when it's fully priced in. We've got sort of a balance of probabilities, a better than 50-50 chance that maybe it comes by the middle of this year. But there's a high chance that we only get the one cut, that it maybe comes at the back end of this year. And again, we've got a lot of Wall Street strategists suggesting that, hey, maybe the cutting cycle's over now, that this is sort of a mid-90s situation, and that, this is pretty much the end of it. Arguably even that maybe the Fed was a little bit too aggressive in the way that it cut interest rates with hindsight. So again, only one cut really fully priced in for this year. That has been deferred to October, and once more, this is just another reason why the markets are selling off. Again, on top of that, in anticipation that inflationary pressures are only going to get greater under the Trump administration.
Now, in relation to currencies, we saw the sterling hit a 14-month low. The Aussie hit its lowest since April 2020, and the euro dropped to its lowest since November 2022. So will we continue to see currencies decline?
Yeah, well, it would seem that there's nothing stopping the US dollar at the moment, and there's a number of factors behind that. Clearly it's this strong US economy that's just fundamentally shooting the lights out. And again, I go back to the fact that we've got a US government that's running a sort of 6 or 7% fiscal deficit as it is now, and that's expected to marginally increase under the Trump administration, which shows that fiscal policy is working very much in favour of the US dollar. The rest of the world is very, very weak. Europe, we're still seeing significant weakness. Still the expectations that rates will be eventually cut there. The other element of that, when we sort of dovetail into the conversation about the Aussie, is the China story, which we'll get a greater update at the end of this week with that sort of monthly China data dump. But still, there's no indication that the rest of the world, other than the United States, is in a very strong position. The problem now is that can have sort of a reflexive element where financial conditions tighten, that lowers risk appetite across the world, that pushes up the US dollar even further, which is already benefiting from those strong fundamentals and those tailwinds that we're getting from potential fiscal policy. And then you overlay that to the potential impact on global growth and capital going back into the United States from the tariffs that the Trump administration could apply, which is still a great deal of uncertainty surrounding that as well. So, clearly we're just seeing these signals of US economic exceptionalism, but also, US fiscal policy that's and trade policy that could potentially be dollar positive as well. And then if you look at the Aussie as just a barometer, like you said, we're at a 4.5-year low. We haven't seen these levels since the pandemic. That is a signal in and of itself that, the global economy ex the United States is pretty weak, and market sentiment is starting to get a little bit shaky. So although positioning is fairly stretched to the upside, and I suspect we might have seen a pullback after the Trump trade at the end of last year, the fundamentals are aligning really well with the US dollar despite some maybe technical headwinds. And it's very difficult to sort of see without major changes to either policy, the economic data, or something that's happening in the rest of the world, that the fundamentals will stop aligning for the US dollar.
Okay, and Kyle, what are some of the market movers this week?
Yeah, I mean, we've got the CPI data that we now turn our focus to in the United States, and that's going to be significant to see whether we do have signals in that of sticky inflationary pressures, and perhaps again this re-acceleration in inflation, which is possible if we sort of go back to the ISM surveys that we got last week, showing that price pressures are sort of forward-looking indicators of prices are picking up again. But domestically, we'll be keeping an eye out for that employment figure here as it relates to what the RBA potentially does next month, and whether jobs growth is still strong here, and maybe continues to counter the argument for policy easing in Australia. And then, there's going to be a lot of focus on China as well, just on the basis that, there is still this major concern of a deflationary spiral there, despite some further talks of stimulus recently from China, just sort of that kind of incremental gradualist approach to sort of providing hope to the markets of further policy support. Chinese markets are dropping, yuan's dropping, which is partly a US dollar story, as well as what's going on in China as well. And that growth data we get at the end of the week, especially the retail sales figure, will give us a good update on whether some of the, again, green shoots that we saw in business surveys recently about China's economy, especially the non-manufacturing sector, is manifesting in stronger retail sales or what have you, or whether we're still in a very moribund state, and where we should still be sort of fairly cautious on China's economy. Again, at a time where it's running into potential political and strategic headwinds because of trade wars. So a lot on the calendar. We start to really pick up from here. Earnings even starts to roll through too, which maybe might offer a bit of a counterpoint to this sort of bearish narrative because of the rate story. But really we're starting to hit the meaningful part of the year. We're out of the holiday slump, and it's all about assessing the rate outlook as well as the growth outlook outside of the United States.